Good morning, everyone. I'm Vince Lancy. Today's market rundown. We're going to take a look at what Trump must do to be successful in his plan to do everything that he said he's going to do. And it's not easy. Uh, we're going to make it practical for everyone. I read a piece by Stephen Blitz at TS Lombard last night about the compound interest on the deficit, and it inspired me to put together uh, an editorial version of his analysis. And well, we'll get to that in a second. Let's start with the markets. The 10-year bond is 421, up 2 basis points in yield. The dollar is 106.39, down 4. S&P 500 is 60.49, up 1. The VIX is 13.35, up 2. Sleepy so far, right? Gold is 26.40, up $1.50 or so. Silver 30.79, up 30 cents, very strong last night. Copper is 4.11, up 2 cents. WTI 69.47, up over $1. Natural gas 291, down 8 cents. Bitcoin down 1,094.771. Ethereum 3602. Palladium, platinum up 5 each. Grains are all up, with wheat at 555, up 6 cents, leading the pack. 993 for soybeans, up 7, almost 8 cents. And corn 420, up a penny. So here's our homepage, Hartnett Part 2, buy gold on any weakness under 2,500. He doesn't spend a lot of time talking about gold, but he's unequivocal in his comments about it, what he does say. So he just believes that gold's going to do well either way. And there's probably physical buying under 2,500. That's me talking, not him. Hartnett, Part 1, U.S. exceptionalism may be at an end. And who's going to buy our bonds now, which will be indirectly what we talk about today as well. Okay, what must Trump do to succeed? Now, Stephen Blitz put together some analysis on compound interest, and he came to some conclusions about what has to be done to succeed in if Trump wishes to succeed, and pretty realistic, and it made me write a couple things about it. There's a lesson in there from him to us in terms of neo-Keynesianism, although he doesn't use that phrase. And there is some practical commentary about Trump's ability to get this all done. So let's do that now. Okay, first of all, this chart here, pretty cool chart, I think, actually. There are a lot of things that you can glean from it, but the one that I think is going to be easiest to see on your screen and easiest to talk about is the red versus the blue. This goes from 1962 to 2023, actually 2032. I'm sorry, he's projecting. And the blue is your deficit, and the red is the interest on it. Now, what you'll see is that as we go further to the right, as the interest, even if the interest rates don't go higher, okay, even if interest rates don't go higher, you can see that the red is pulling away from the blue here on the right. And that's because of compound interest. And that's the gist of the whole report, that some things have to change or the compound interest will kill us. Another thing I want to draw your attention to is, see the black line? The black line is public debt outstanding. So below zero is between 1962 and 2008. Okay. So during that time, public debt was held by the private sector, not the government. And then 2008, 2009 was the beginning of the government owning its own debt. So you could see what's happening here. The government has, after 2008, the government has bailed out everyone on Wall Street and some people on Main Street, and to keep the economy up. And now that black line there that's going up, they need to get that below the 0 point again. And that's the problem with the whole who's going to buy our bonds now thing. All right, so The first, so here's four summary points that I'll share with you that I took out of it. The first one is persistent deficits short circuit capital investment cycles and kill growth. That's the lesson that comes from this, and the vernacular will be: we weren't crazy. Constantly spending without saving can't go on forever. So in English, persistent deficits short circuit capital investment cycles and kill growth. Well, uh, deficit spending, right? Which we do from a Keynesian point of view. Oh, it's okay to spend a little bit of money to get the economy goosed, right? That's Keynesian, to my knowledge, right? I'm not an economist, right? Uh, Neo-Keynesian is uh, we're going to spend a little money to goose the economy, and then when we make the money back, we're not going to ungoose the economy and reduce our deficit. We're going to keep doing more and keep pushing it up the ladder, which is what that chart shows. So persistent deficits, as opposed to intermittent or cyclical deficits, they short circuit a country's bias towards investing in itself. Well, shit, if I'm going to be bailed out, why would I invest? Why would I invest in infrastructure? Why would I invest in fixing this? We'll just use money to paper over everything. And so he's saying, quite academically, but it's a behavioral comment, that if you keep bailing people out, then they're not going to invest in bailing themselves out. So we weren't crazy. Constantly spending without cyclically saving can't go on forever. All right. Number two, the Fed must monetize the debt, and he gets into this. And let me give you one of the quotes, because I think it's actually, I'll paraphrase it a little bit. The rising cost of servicing U.S. debt. This is the compound debt part, right? Wait, that's this one. Here we go. The Fed must monetize the debt. The rising cost of servicing U.S. debt, coupled with a structural deficit of 2.5–3% of GDP, is creating significant pressure. Structural deficit, for those of you not familiar with that phrase, means we're structurally spending more than we have to because we have these permanent obligations, meaning big government. That's structural deficit spending. Okay, to prevent real interest costs from dragging down economic growth, here we go, monetization of debt, and derailing policy goals, Trump's policy goals, the Federal Reserve is increasingly likely to monetize more of the debt. Weaker dollar. It has to happen for Trump to succeed, in my opinion. Third point, unemployment must rise or productivity will drop. What did I write there in my notes? My whole note on this whole thing is people need to get fired. All right. Trump's vision for boosting growth is anchored on increased domestic production. We need to make more stuff, right? Budget-driven incentives and tariffs to finance the tax cuts he wants to do locally. It's flawed. Okay, it's fundamentally, I'm paraphrasing Stephen Blitz here, but I kind of agree with him. It's fundamentally flawed unless the structural budget deficit begins to shrink. Now, here's the beauty of it. This is like where you're like, oh, this is great. Okay, it can't happen unless people get fired at the government level. Okay, the structural deficit that I just described needs to be reduced, because if we don't reduce permanent obligations, I need to spend this money every month on my nut, to for my fixed overhead. Unless we reduce the fixed overhead, right, it's not going to work. So unemployment has to rise, or productivity must drop. I put that in there because if unemployment doesn't rise, then we're not firing enough people, and if productivity drops, then we're not going to be able to get the growth we need. And so you do more monetization. Anyway, next, and this is me, kind of taking what Steven said and making it a little bit more pessimistic. Odds are against all of this happening. Now, I think Steven's phrasing was like, it won't be easy to do, that sort of tone. Now, but circling back to unemployment must rise or productivity must stop for 1 second, there is one thing. Addressing the structural deficit, we got to fire people, will require more than just good intentions. Now, Trump and his administration seem to recognize this, as evidenced by the formation of DOGE, Department of Government Efficiency or Growth and Expenditures. I'm not sure what it means, but it basically it's who we're going to fire, right? Additionally, Republicans in Congress are now eyeing entitlement cuts as part of the solution. So government must shrink. Now, whether that's what they're going to cut is where your pushback from the Democrats is going to come. Anyway, so back to the it won't be easy to do part. All right. Cutting entitlements and imposing fiscal discipline comes with significant political pushback, right? Okay. To succeed, some difficult decisions will need to be made, and as blunt as it sounds, people, figuratively and literally, may need to be fired. The reality is that without hard choices, the deficit problem will persist, and the broader goal of stabilizing the economy will remain out of reach. Okay? Now, to put it on a timeline for you, at least for me, if Trump can't get this in play meaningfully in his first 100 days, then he goes from a guy with a mandate to a lame duck, potentially, because as time goes on, these senators, right now we're kind of channeling Hartnett, these senators and congressmen who want to get reelected, they're like, people worry about inflation again. I can't back what Trump wants to do. We're not going to be able to reduce taxes. These sort of things start to fall by the wayside. And that senator or congressman to get reelected will do whatever he needs to do to satisfy what the voters are crying about. And they used to cry about unemployment. Now they're crying about inflation. So if inflation perks up, then and Trump hasn't gotten what he needs to get done, well, they're going to start backing away from him. That's my opinion. So I guess you just buy gold. No, yes, you would actually just buy gold. And this is a chart that Stephen Blitz has in there, but I call this Yellen's legacy. And this chart's not going to be much to you at first glance, but it's kind of like this. If you have money that you need to borrow, you can borrow it on a 30-year mortgage, right? Or you can borrow it on a 1-year mortgage. And the 30-year mortgage is fixed and it sucks and you're paying a high interest rate, but it's one and done. Boom. Or you can buy a 1%, think about it like 10 years ago, a 1% variable rate mortgage. And you're like, that's okay. Each year I'll just roll it. That's what Yellen did. Each year she's rolling, we're going with T-bills. We're not going with coupons. We're going with short-term stuff. And that's fine if you're trying to avoid the long-term higher rate and you're betting on rates coming down, which she was right about because, well, they know what they're doing. But what happens when interest rates move? Now, if you had financed at the 30-year out and interest rates went up, you wouldn't care, right? You already have your mortgage locked in, right? But they're not. They're financing at the short end. So if rates start to go up again, that red-blue spread that I showed you, it gets even bigger. So monetization has to happen. And my bet is, if I wanted to really time this, if Trump doesn't want to get what he wants to get done in the first 100 days, call it first, year, if you want, then the Republicans are going to say, okay, we can't get this done. We have to keep inflation under control. And one way to keep inflation under control is by debasing the currency, which means not inflation. We'll sacrifice unemployment and inflation for credit. I'm sorry, to put it in English, the person who succeeds Powell will just be like lowering rates to zero. That's my guess. Because if they can't get it done, they're going to kick the bucket down the road once again. All right, news and analysis. Hartnett Part 2. Not a lot of stories yesterday. Hartnett Part 2. China has secretly been buying gold since May 2024. That's Jerusalem Post picked up our story and with some nice new graphics in there. So I copied and put that in there. Gold under Trump tariffs, combining Hartnett with Oliver. That's yesterday's morning thing. And Hartnett, U.S. exceptionalism is at an end. We're going to skip the news today. There's news, but let's just skip it for the moment. Unemployment is this week. Today is auto sales and premium. I have the whole talk that I just gave you a short version of underneath here, too long didn't read, the whole section there. And then I also have Stephen Blitz's analysis, which is quite good. Let's take a look at the markets. And there's nothing new to add. There's nothing new to add, right? Okay. And every day doesn't have to be exciting. We need to breathe, right? In between these two areas, you don't care. Okay, so now where's the fun stuff? Well, the fun stuff is silver rejected the 100-day moving average higher. Pretty cool, right? So maybe there's something going on in the silver physical side. I don't know yet. We'll have to look into it. But this off the lows, this getting off the mat without gold moving means nothing to me. It just means that silver's starting to move. It's its own commodity again. All right, Vince. Have a great day.